Hi everybody, I'm Ken Malott of Malott Financial Advisors. Today I'm making a video about questions you should ask when hiring a financial advisor. Now this was a topic suggested to me by an existing client and I thought it was a good one, so here you go. Now keep in mind there's not always a right or wrong with these answers. You're trying to gauge the advisor's expertise and their skill, their thoughtfulness, and their trustworthiness. So the first question should be, how do you get paid? Because there are two ways advisors get paid. There's commission-based advisors and there's fee-based advisors. Commissions typically get paid by a mutual fund company or an insurance company if the advisor sells insurance and annuities. Now the key here is that the advisor is being compensated by an outside, unrelated third party that does not have your best interests in mind. So the obvious problem with this is that there is a conflict of interest because the advisor is being incentivized to sell you something that may or may not be in your best interest or may even be detrimental to your financial situation. The alternative to commissions is fees. So whether it's a flat dollar fee or a percentage of assets under management, the structure is less important, but that the point is that the client is the only person who is compensating the advisor. So there is no outside undue influence by an unrelated third party, right? You want your advisor's interest to be aligned with your interest, and to do that, you have to be the only one paying the advisor. And I'm telling you, the insurance annuity sales are extremely lucrative for advisors. So this is why advisors who are licensed to sell them push them so hard, because they get a big chunk of money up front when they sell those contracts. Once you find out how they get paid, you want to find out how much they get paid. So what is their fee schedule if they're a fee-only advisor, or what kind of commissions are they getting if they're commission-based? Chances are fee-based advisors are very transparent because the fee schedules are very easy to understand and they're very simple. And my fees are right here. So you'll notice that my fee schedule is very simple, it's transparent, it's easy to understand, and it's low cost. So the bottom line is make sure your advisor is not licensed to sell insurance or annuities, because chances are they're going to be influenced and they're going to be incentivized to sell you things that you don't need. And they're going to make a very compelling case for those products because they get paid very well for selling them. Another relevant follow-up to that question about expenses is, what is the average expense ratio of the underlying investments? So if your advisor is using mutual funds and ETFs and other pooled vehicles, those investments have an embedded expense within them as well. So you want to find out, what is the average expense of those portfolios the advisor is managing. Now my portfolios, the average expense ratio is very low. It's anywhere from 0.3 to 0.4%. Now I've seen prospects come in, and this is quite common, where the expense ratio is 1 to 2%. So then you got to tack on that 1 to 2% to the advisor's fee, which may be another 1 to 1.5%, depending what they've got going. So now you're talking about at least a 2 to 3% total expense for the portfolio every single year. That adds up to significant dollars over a 30 and 40-year time horizon. You just cannot overcome a 3% expense bogey. Then once you have a good feel for how the advisor is compensated and how much they're compensated, you need to find out what services are included with that fee. So obviously portfolio management, but how is it monitored? Who's monitoring the portfolio? Who's serving you? How often are they meeting with you? Is it quarterly? Is it every 6 months, every year? How often are you going to hear from your advisor? And are you going to hear from your advisor, or are you going to hear from an assistant, right? Because if an advisor has a very large book, chances are you're going to be dealing with an assistant. Beyond that, you want to make sure that planning is included for that fee, right? Because a lot of advisors will charge extra to do financial planning. But financial planning is the blueprint for every financial decision that you have to make together with your advisor. So I don't understand how you can go into that relationship without doing the planning right up front. In most cases, the planning needs to be done immediately because every other decision flows from that plan. So you want to make sure that not only is the planning included, but that the advisor emphasizes the planning process and uses it as a critical tool for all the rest of the decision making. So next, you want to find out how our portfolio is constructed. So what asset classes are being included, and what is the weighting of those asset classes, and how are those things determined, right? And then beyond that, are they using active investment options, or are they using passive low-cost index options, or is there a blend of both? Again, here there is no right or wrong answer necessarily. I use both active and passive, and it just depends on what asset class we're talking about, because some are more efficient and lend themselves to indexing, while others are less efficient, more opaque, like emerging markets, where I think it pays to have an active manager. So what you're trying to accomplish by asking this question is to get a feel for the advisor's expertise and their depth of knowledge. And then beyond that, how are they implementing the portfolio? Is it using mutual funds, ETFs, individual securities, other pooled investments, options? How are they structuring the portfolio, and how are these decisions being made? Ultimately, what are you going to own is what you're trying to figure out here, and why. The next question is, has there been any disciplinary action? Does the advisor have any complaints against them, or have there been any lawsuits levied against them, or any settlements from a former client or a regulator? Are they held to the fiduciary standard as opposed to just a suitability standard? And then the last question is, how are they managing taxes for you throughout the year? Because there are many strategies that advisors can use to help mitigate your tax liability. After all, it's not what you make that matters, but what you keep that matters. So you have to be wary of taxes, and not just within the portfolio, but within your situation overall, because that information can be very useful when managing a portfolio or when coming up with tax-saving strategies to reduce your tax liability over time. So anyway, by the end of the meeting, you should have a good feel if this advisor is a good fit for you and your family, right? It's a very serious responsibility that you're entrusting with them. So you should feel very comfortable. You should be able to trust them. You should be able to feel that they're giving you complete, satisfactory answers. And after you've met with a couple advisors, you kind of get a feel for good ones and bad ones. So anyway, I hope this helps and gets you on the right foot. Have a great night.